Meta Platforms, formerly Facebook, spent over $36 billion building Horizon Worlds, its flagship metaverse platform. By 2023, daily active users were estimated at 200,000, roughly the population of Reno, Nevada. Meanwhile, Roblox has 80 million daily active users, mostly under 16, generating over $3 billion in annual revenue from digital item sales. Fortnite has generated over $20 billion in revenue from virtual cosmetics. The gaming industry's virtual economy is already the size of several mid-cap S&P 500 companies. The institutional bet on the metaverse was largely directed at the wrong platforms, centralized corporate virtual worlds that lack the organic community that drives digital economy value. The real metaverse economy is the gaming industry, and blockchain is beginning to penetrate it, not through corporate metaverse platforms, but through gaming-native NFT ownership and on-chain asset portability. For institutional investors, this recalibration changes where digital economy value accrues and which assets deserve portfolio consideration. The metaverse economy encompasses three distinct value creation mechanisms that require separate institutional analysis. First is virtual goods and cosmetics, digital items within games that have no blockchain component. This market is already worth over $40 billion annually and is entirely dominated by traditional gaming companies. Second is blockchain gaming, games that use NFTs to represent in-game assets, enabling true player ownership and secondary market trading. Third is virtual real estate, blockchain-based platforms like Decentraland and the Sandbox that sell land as NFTs. Each of these markets has different maturity, different risk profiles, and different institutional relevance. The institutional era of 2021 to 2022 was conflating all three under the metaverse label and allocating to the least mature category, virtual real estate, while the most mature category, traditional virtual goods, required no blockchain exposure whatsoever. The market data across digital economy segments reveals the stark maturity gap. The traditional gaming virtual goods market generates approximately $45 billion annually. Roblox contributes $3 billion, Fortnite $5 to $6 billion, League of Legends $1.7 billion. These businesses have durable revenue models, massive user bases, and no blockchain component. Blockchain gaming peaked in 2021 with Axie Infinity generating $1.3 billion in NFT trading volume, a record that collapsed to under $50 million by 2024 as the play-to-earn model became unsustainable. Second-generation blockchain games focusing on genuine gameplay rather than financial mechanics have regrown to approximately $400 million in quarterly NFT volume by Q1 2026. Virtual real estate in Decentraland and Sandbox saw land prices collapse 95% from 2021 peaks. Decentraland's daily active users number in the hundreds, not millions. The data is unambiguous. Blockchain gaming is recovering on sounder foundations. Virtual real estate speculation has effectively failed. The institutional comparison is between speculative metaverse virtual real estate and blockchain gaming with genuine gameplay mechanics. Virtual real estate platforms like Decentraland and Sandbox attracted massive institutional investment in 2021 based on the thesis that digital land would appreciate as more users populated virtual worlds. This thesis failed because these platforms had almost no organic users. Virtual land value required user adoption that never materialized. Blockchain gaming with genuine gameplay mechanics, games where the blockchain component enhances player experience rather than driving financial speculation, has demonstrated more durable user engagement. Immutable's gaming platform, Gods Unchained, and Ronin-based games have maintained user bases through market downturns. The institutional lesson is to evaluate digital economy exposure on the basis of active users and revenue generation, not on speculative land price appreciation or NFT floor prices. Institutional digital economy investments carry risks that differ significantly from traditional gaming equity or direct crypto exposure. Speculative adoption risk is primary. Virtual real estate and blockchain gaming valuations in 2021 were based on adoption projections that were never realized. The gap between anticipated and actual user adoption was the primary driver of 90+% value declines. Platform dependency risk is the second concern. Blockchain games and virtual worlds are built on specific blockchain platforms, Ethereum, Immutable, Ronin, and a security exploit on the underlying platform can instantly destroy the value of all in-game assets. The Ronin bridge hack of 2022 stole $625 million from Axie Infinity's ecosystem in a single attack. Third is the incumbent competition risk. Roblox, Epic Games, Fortnite, and Riot Games have billions in resources and established user bases. Blockchain games competing against them for user attention face structural disadvantages in game quality and distribution. The Axie Infinity boom and collapse is the defining case study for blockchain gaming institutional analysis. Axie Infinity, a Pokemon-inspired game where players earn SLP tokens by playing, generated $1.3 billion in NFT trading volume in 2021 and had over 2.7 million daily active users at its peak, mostly in the Philippines and Southeast Asia where the play-to-earn income was meaningful relative to local wages. Sky Mavis, Axie's developer, raised $152 million at a $3 billion valuation from A16Z, Binance, and others. The model collapsed in early 2022 when SLP token inflation caused by an unlimited supply of earned tokens overwhelmed demand. Token prices fell 99%. The March 2022 Ronin Bridge hack then stole $625 million. The lesson: blockchain gaming models that create financial incentives as the primary engagement driver attract speculators, not genuine players. When financial returns disappear, the user base disappears with them. Genuine gaming engagement must be the primary driver of retention. Institutions evaluating digital economy investments should apply a four-step user economics framework that prioritizes organic engagement over financial speculation. Step 1 is DAU quality assessment. Evaluate daily active user counts and distinguish between players engaged by gameplay and players engaged by financial reward. If user retention collapses when token rewards decline, the user base is speculative, not organic. Step 2 is revenue model analysis. Assess whether the platform generates revenue from genuine entertainment value, cosmetics, subscriptions, DLC, or from secondary NFT market speculation. Sustainable digital economies have both. Step 3 is platform security audit. Evaluate the security architecture of the blockchain underlying the game. Any platform using a bridge to Ethereum must have an independent security audit of the bridge architecture. Step 4 is incumbents comparison. Benchmark the blockchain game's user experience, graphics quality, and content depth against traditional gaming incumbents in the same genre. 3 digital economy investment mistakes define the 2021 to 2022 institutional wave. First, treating virtual land as equivalent to physical real estate without user adoption evidence. Real estate value requires demand, and virtual real estate demand requires users. Decentraland had neither in quantity. Second, investing in play-to-earn games without stress testing the token economics when token prices decline. If the only reason users play is to earn tokens, a 50% token price decline will drive away 50% of users. Third, underweighting platform security risk on bridge architectures. The Ronin hack stole $625 million in less than a day, demonstrating that inadequate bridge security is an existential risk for blockchain gaming ecosystems. The metaverse economy is real and growing, but it's the gaming industry, not the corporate virtual worlds or speculative land markets that attracted institutional capital in 2021. Blockchain gaming is developing on sounder foundations focused on genuine player ownership rather than financial speculation. The institutional framework is to evaluate digital economy exposure on user economics and revenue quality, not on speculative land prices or NFT floor values. The digital economy is one of the most misunderstood institutional investment themes in crypto, and getting the analytical framework right separates durable allocation from speculative capital loss. Subscribe to Crypto Mechanics for institutional-grade crypto analysis delivered weekly.